Economists are now warning that we could already be in recession this year, and that the recession actually might have started even a couple months ago. This is huge news you need to pay attention to as a home buyer or a real estate investor. We could see big job losses in the economy in coming months, and the statistics are now saying that we're at an inflection point that's similar to what we saw in late 2007 before the last big bust. And the most recent report that confirms this is the latest job figures from the Bureau of Labor Statistics. Job growth was only 77,000 in July 2025, and there was big downward revisions for previous months. This now brings U.S. job growth year over year to only 0.97%. That's less than 1% job growth. Such low job growth is now echoing what we saw in late 2007 before the last big crash, and also early 2001 before the dot-com bubble. Now, there's some controversy over these job figures, everyone, because Donald Trump came out and said that the head of the Bureau of Labor Statistics was partisan and a Biden administration employee, and thus Trump's accusation was that they're rigging the numbers, and Trump fired the head of the Bureau of Labor Statistics as a result. And so now there are some questions about the accuracy and validity of the Bureau of Labor Statistics figures. And you guys can let me know what you think about it. Do you think the government jobs numbers are a decent representation of the economy? So what I actually wanted to do, everyone, for you guys is look at some other statistics on the economy, on the labor market, and assess where are we truly, and are we actually already in a recession? And to do this, everyone, I pulled 3 separate data points that also track employment. One is the Indeed Job Openings Index. And the Indeed Job Openings Index, which is how many jobs are posted on Indeed, this data comes straight from Indeed, the job postings website, is down to 105. Now, that's down 35% from the pandemic peak, the job openings on Indeed, and now it's almost back to pre-pandemic levels. So that's a data point confirming the big slowdown in hiring. In addition, the ISM Manufacturing Employment Index is now at the lowest level in 10 years, excluding the pandemic. So are manufacturing companies adding or subtracting employment? They're subtracting employment at the fastest rate in 10 years, if you exclude the pandemic. That comes from the Institute of Supply Management. Additionally, the ISM Services Employment Index is down to a 46.4. That's the 3rd lowest level in the last 10 years. So these alternative measures of the labor market are all suggesting that we are in a job market recession, or at the very least, we're in a pre-recession, similar to fall 2007, as well as winter, spring 2001. Now, winter, spring 2001, everyone, that was right before the dot-com bust, right before the stock market went down 50%. August 2007 was right before the great financial collapse, when the housing market bust happened and the stock market also went down by 50%. The employment growth today is now looking even worse than it did in those periods right before those 2 recessions by almost every metric, whether it's the BLS jobs figures or the ISM Manufacturing and Services Employment Index. So this is not speculative to say the employment situation is bad. It's not speculative to say that the labor market has turned for worse. And if someone tries to say that the economy is booming right now, I mean, that's just factually not accurate based on the data from multiple different sources. And I actually polled you guys on my channel, and I asked you all the question, do you think we're in a recession right now? Because I wanted to get your take on it. Like, what are you guys out there thinking? What do you think about the economy? You know, I talked to you guys a lot about the data, but just what's your feeling about what's going on? 68% of you think we're in a recession right now. Over 2/3 of you think we're already in a recession, and it's split about 15% those of you who think we're not in a recession or we might be in a recession. So the vast majority of you think we're already in a recession or we might be in a recession, over 80%. And I think a lot of Americans feel that way as well. Americans have been crushed by over 3 years of inflation that started in 2021 and really went through 2024. 3 years of inflation really hurt Americans' finances and confidence in the economy. At the same time, the housing market's still in a big bubble. Home prices are still way too high. People can't afford homes. And oh, by the way, if you're a white-collar worker now, finding a job as a white-collar worker is almost impossible. Recent college graduates with white-collar degrees are finding themselves with high unemployment rates. People who went to college for computer science and engineering have like the highest unemployment rate. And I know a lot of people working in finance and tech right now, and they're having a difficult time finding a job. So this is a really tough economy, and the Trump administration should align with the reality of actually what's happening. And the more that they try to claim that the economy is great and that the economy is booming, the more that they're going to increase the odds they lose the midterm elections in 2026, because people aren't dumb. You can't tell the American people the economy is good when they know the economy is not good. That's what the Biden administration tried to do with inflation. The Biden administration tried to pretend like inflation wasn't happening, and they ended up losing an election because of that. The Trump administration has to get with reality and understand that the economy was already heading in this trajectory before Trump took office, and that this is inevitable. It's inevitable that we're going to see some type of correction or recession. It's just the economic cycle. Things got too expensive. And so to try to say it won't happen and to try to pretend like things are good when they're not good, and to fire the head of the Bureau of Labor Statistics because of a bad job report, that is not good. Now, I want to give you all some predictions out there about what I think we're going to need to see in terms of rate cuts and home price declines to bring home buyers back into the market. And on this chart, you can see what needs to happen to make home prices cheaper and bring affordability back in. If we see a 20% decline in prices to go along with mortgage rates going to around 5%, that would drop the monthly payment to buy a house, inclusive of taxes and insurance, from $2,800 a month, where it is today, down to around $1,950 a month. So we're at a $2,800 a month payment today. Understand these figures, everyone, because I think this is what we're going to need to see for buyers to come back. $2,800 a month monthly payment across the U.S. for a buyer today on average. If we get that to $1,950, buyers will come back. But to get there, it requires a 20% decline in prices and mortgage rates going to 5%. And that's my kind of like rule of thumb of what we need to see to bring equilibrium back into the market and to help re-stimulate the market. At Reventure app, we think US home prices right now are around 17% overvalued. So we're not projecting a 20% decline in prices right now. In fact, we think prices are only going to go down around 1 to 2% over the next year based on the current data. However, if the job market continues worsening, if a recession happens, there's more job losses, it's conceivable to think there'll be more forced selling, there'll be more distress, and that prices could drop more into the future in that scenario. But when I looked at the data, I thought it was really interesting. I went back to 2001, right before the dot-com bust, and I looked, and the Fed cut interest rates in January 2001. Right before the recession. The recession started about 2 months after that. And when the Fed cut rates in January 2001, the employment growth was around 1.4% year over year from the BLS when the Fed cut rates in 2001 prior to that recession. Employment growth today is only 0.97%. Additionally, the ISM Services and Manufacturing Employment Indexes were in a better place in aggregate in January 2001 when the Fed cut than they are today. And what this suggests is that the Fed might be late cutting rates in terms of the labor market. The Fed's mandate is to balance labor market health versus inflation. Well, the labor market health is deteriorating rapidly, and the Fed has not cut rates yet. In 2001, prior to the dot-com bust, the Fed would have already cut based on the same economic data in this cycle. They probably would have cut 3 or 4 months ago if they were going off the same economic data. So that's 2001, suggests that the Fed is late this time around. But I want to point you guys to 2007. Because 2007, if you're a home buyer or an investor or someone just trying to understand the market right now, understand the dynamics of what happened in 07 before that last big bust. Because the similarities just keep piling up. So the Fed cut interest rates in August 07. That was the first rate cut. Rates were around 5.3%, 5.5%. They did one rate cut August 07. Now, the recession didn't officially start for another 3 or 4 months, and Lehman Brothers actually didn't happen for another 10 months. But when the Fed did that rate cut in August 07, the employment growth was around 1% year over year. So employment growth from the BLS was similar to what it was today. But again, the aggregate ISM Services and Manufacturing Employment Indexes were better than they are today. And again, the ISM Services Manufacturing Index, what that is, it's important for you guys to understand. It's an alternative measure of the health of the job market that comes from the Institute for Supply Management. They've been coming out with these surveys for 40 to 50 years on the health of the economy, on the health of employment. And those surveys are saying the employment situation in the economy today is significantly worse than it was in August '07 when the Fed cut rates in that cycle. Fed still hasn't cut rates in this cycle. So that's another data point suggesting the Fed is late on rate cuts. And I was actually kind of surprised by this data when I dug into it, everyone, because I've been of the mindset that, rate cuts aren't going to really change the ball game too much on home prices in the housing market. And I still think that. I don't think home buyers are really going to come back in when the Fed inevitably cuts rates in September. But it is shocking to see that prior to the two biggest asset bubble collapses we've seen in recent history, the Fed was way more aggressive in cutting rates earlier than they are today, suggesting that the Fed could be behind the curve, and if the Fed is behind the curve, it could make the resulting recession worse. But what that helps you all understand, everyone, is that mortgage rates on their own are not going to get the housing market going again. Mortgage rates dropping to 5% with no decline in prices, that's only going to lower the monthly payment to $24.50 a month, which would be about 35% of median income. That is not enough to bring buyers back. And I just wish more people in the housing market could understand this. More realtors, more sellers, more investors, is that the mortgage rate narrative, that's somehow what controls demand on a string, is just not true. And we know it's not true because the Fed cut rates 100 basis points last year, and demand this year is lower than last year. Think about that, everyone. The Fed cut interest rates last year. Do you all remember that? The Fed cut rates from 5.5 to 4.5. The result of those rate cuts was home buyer demand dropping further. And one additional stat I want to show you all to help explain the current state of the housing market is this chart on homeowner equity in the US. Now, homeowners have $34 trillion of equity in their homes. And what that means is that there's 34 more trillion in value than there is in mortgage debt. So the total value of the US housing market is around 47, 48 trillion. There's around 14 trillion in mortgage debt. So that's 34 trillion in equity. And you can see this equity amount is almost 3 times higher than it was in 2006 at the peak of the last bubble. I mean, this graph is absolutely crazy how much equity current homeowners have. And what that high homeowner equity means, everyone, is that we're in a housing bubble, because that high homeowner equity isn't actually supported by fundamentals related to income, rent, or GDP. In fact, the homeowner equity to GDP ratio in the US is currently 115%. There's more homeowner equity than there is the size of the economy. That's the highest homeowner equity to GDP ratio we've ever seen in the US, even higher than the '06 bubble. So the overall point is, everyone, prices need to drop. Homeowner equity levels are too high. Sellers need to get rid of this idea that their house is worth $700,000 when it's actually worth $550,000. And until we get to that point, when sellers can finally start admitting that the market has shifted and accept just a little less equity, right? I mean, these sellers could take 20% less equity and we'd still have by far a record amount of equity, right? This is the thing that needs to happen. And like, everyone in the housing market needs to get on board with this, including the Trump administration. Stop focusing on mortgage rates. Focus on home prices and getting sellers to cut prices. Because this homeowner equity graph is ridiculous. It's ridiculous that we have, 100 million owned homes in America, and the people who own these 100 million homes are just sitting on all this equity, all this phantom wealth, and refusing to just give up some small percent, 15 to 20%. That's all we need to give up, 15 to 20% of this, and then the market works and the economy rebounds and Americans can buy homes again. I mean, I think a lot of people might be fearful that a 20% home price correction would lead to another 2008, contagion effect in the economy. I don't think it will. Because in 2008, home prices going down 25% in the US meant a lot of people were underwater, especially in Florida, Arizona, and California. This time around, homeowners have plenty of room to absorb a 20% decline in home prices. And one thing that our users on ReVenture app are finding success with, everyone, is they're using our price forecast and taking that price forecast to sellers and listing agents and actually negotiating cheaper prices. Using this objective price forecast, you can actually negotiate with sellers and help them get out of their own way sometimes, right? Like some sellers just think their house is worth 500 grand. They don't want to negotiate. However, when you bring objective data to them, saying that the market's declining, in this zip code we think prices are going to drop 9% over the next year, some sellers are now waking up to the fact like, oh, maybe I should sell my house. And we're finding more and more examples of our users on Reventure app saving anywhere from $50,000 to $80,000 on home purchases by using this home price forecast data. We actually just had a home buyer in Phoenix use a forecast in Phoenix. The zip code was -9%. They offered $80,000 below asking price on the house based on that forecast. They got the house. They didn't think they were going to get it, and they also got some more incentives based on bringing that forecast to the builder and using it to inform their offer. So if you are interested in buying a house right now, everyone, understand that you can get good deals. There are some sellers willing to negotiate if you present the data and if you make informed offers and respectful offers based off data. And by doing that, you can save tens of thousands of dollars. And we're making that data available to you on Reventure app. Sign up for a premium plan on Reventure app right now to access that price forecast in your market and get ready to make offers based on where the forecast is going. In about half the country, we have a downward forecast. In the other half of the country, we have a stable or upward forecast. You're going to want to see where that 12-month forecast is in your area and then use it to find the areas where prices are going to go down the most and where you can negotiate the best deals. The premium plan right now is $39 a month. We're going to be increasing the price on that to $49 a month on August 18th. So I would suggest you guys right now sign up for the $39 a month. You can lock that in before August 18th, before it goes up to $49. All existing premium members, before August 18th, you're going to be at $39. You're going to lock that in as long as you keep your subscription active. After August 18th, any new subscription purchased is going to be at $49. So go there right now, lock in the lower rate, $39 a month before it goes up. Access that price forecast for your area.